right, welcome. Let's everyone jump in. Natural gas has caught my eye. I was 2 seconds late to start this thing. This will be the first time, probably since around February, that natural gas has closed above 2 on the CFD. Interesting one. That's been unloved for so long, natural gas. And it seems like every other commodity has had caught a bid. Obviously, gold. There's not wherever you've been, if you've not seen gold just rip into highs all the time. Silver, cocoa, which is a bit of a bizarre one. The others have started to kick into gear a bit now. Copper had a big old bid after having that pullback. But natural gas has been a bit unloved. Obviously, oil's very much driven by headlines. But natural gas, yeah, really struggling. Considering that's been up at, in August 22, we were looking at, what were we looking at back then? $9 bucks, $10, something like that. So if you're joining me, welcome. I'm just kind of browsing some markets in my other screen and we're ready to get started. I'll get started in a moment. Thank you for joining me. Appreciate your time and effort. And it's a busy market at the moment as well. So I know there's a lot going on. Is this the pullback to new highs on the NASDAQ? Is this the pullback to new highs? Have we had the pullback? Are we going to visit fresh highs? Have we locked and loaded 40,000 in on the Dow? Time will tell, but we have a 3-day bid in progress. We had a reversal on the Friday and we had the Monday move. Today, we'll get a follow through. Ooh, turnaround Tuesday is often the old adage, but I find that tends to work the other way. So you have a weak Friday, you have a weak Monday, and then you look for the turnaround on Tuesday. But who knows, man? Who knows? No one knows. But it'll be interesting to see FTSE trading up above 8,000 again. Finally. Yeah, so lots going on. All right, let's get started, ladies and gents. So I'm Mark Holstead. If you don't know, many of you know me already. And my objective today is to cover some optimal risk management strategies. So what I really want to do is, just share and talk about some different ways to manage risk. So stop loss formula, I'm going to share with you risk management formula, etc. So let me just shift my camera around. Bear with me a second. All right, let's get going. Okay, so if you can hear me okay, usual, what we're going to do with this is I will talk for 45 minutes or so. If you have any questions, the Q&A section, stick them in there. I'll get to those at the end and I will try my very, very best to help you out. By the way, a lot of you, some say, oh, what's behind you? You've got some books and stuff. And I have my little trader's reading chair there. Pitbull, this is a great, great, great book. Really good storybook. It's Lessons from Wall Street's Champion Day Trade. It's about Marty Schwartz. He basically came from the pits, developed his own trading strategy, started his own little fund, didn't like that, traded his own money. It's a real great story about an independent retail trader who did pretty well for himself. So definitely recommend this book. It's not very banded around much in the kind of trading community, but I highly recommend it. You're not going to learn much strategy in there. You're not going to learn anything about psychology. Well, it's a storybook, so you will learn something just by the fact of reading it, but definitely an interesting book, well worth reading. Pitbull by Marty Schwartz, if you missed that one. Okay, so this is not a book recommendation. This is optimal risk management strategies. Let's get rolling. I'm just checking on my other screen to make sure we are good to go. I think we are. Let's rock. Okay, risk warning. You know the rules, ladies and gents. This is how it works. It's a very risky business. You can make a lot of money, can lose a lot of money. And you're trading with leverage. So that's how it works. It amplifies the gains, amplifies the risks. A high risk of losing money when you're trading CFDs, spread bets, any leveraged product. So be careful and be warned. Right, let's get going. Optimal risk management strategies. Great quote here. Peter Bernstein. He says, the essence of risk management lies in maximizing the areas where we have some control over the outcome while minimizing the areas where we absolutely have absolutely no control. Such a good quote. I don't think this guy's a trader per se, more an investor, but such a good quote. Let's manage and let's control and manage the risk where we can manage it, because our control is our position size, where we put our stop loss, how we manage a trade. I'm going to cover all this today, and hopefully, there's something in there that will just go, aha, a little light bulb moment. And I don't need many of those actually to help you move forward in trading. Not every single webinar or bit of content you consume is going to be like amazing, but if it just makes you think differently or just makes you kind of adjust the lens you look through a little bit, then that is sometimes all you need to go around an obstacle and make some forward progress. So that's my objective with all these webinars. I do these kind of once every couple of weeks with Pepperstone, and trying to talk about different things, trying to get new ideas in around and share things that have worked for me over my 20-year trading career, things that I've seen work for others, and really just kind of give you something to get your teeth into that you can go and pursue a little bit more in your own time. Okay, so risk management strategies. Let's get rolling. Okay, our goal for today: getting better at risk management, stop loss placement, moving stops, managing risk with size, and non-negotiable risk rules. So before we start, okay, so risk management, it's a pretty dull topic, right? It's like, risk management, Mark. Can't you find something more exciting to talk about? I want to next trade that's going to rip off, how to capture trends or how to trade size and all this sexy stuff. And yeah, fine, but do you know what? Risk is the most important thing in trading. Without capital, you cannot trade. As simple as that. You might top it back up again, but at some point, if you run out of capital, you cannot trade anymore. So be aware of that. It's so important to manage risk. And also, as you probably are fully aware, as you start to do damage to your trading account and your equity curve starts to go downwards instead of upwards, that also erodes your mental capital. So it's a super important topic. And those of you who are here now, live, watching this, credit to you for taking it seriously enough to say, you know what, I'm going to devote 60 minutes of my time to seeing if I can learn something new in this field. So good for you. And if you're watching the recording, if the recording's out, then welcome as well. And I'm going to give you something valuable. Okay, so before we start, this is so important. Make sure you're not the chink in the armor. And what I mean by this is you can do everything possible to manage your risk. And you can do all the things we're going to talk about in a moment, optimal ways for, I believe, positioning stops and moving stops and other ways to manage risk and all this type of stuff. But if you can't stick to your rules, it's completely pointless. If you've got all this great risk management strategy and you've got these unique ways and methods and kind of clever things that you're going to do to kind of mitigate the risk and maximize the gains, because we all want to make as much money as possible with the least amount of risk possible, right? That's the name of the game with trading. That's why we're in the business. That's why we trade on margin. We understand it's high risk, but we also want to get the other side of the coin as well and get the big rewards. We're trying to minimize the amount we're risking to maximize the amount we're making. Never going to always work like that, but that's what we're trying to do. So it works out in the wash. But if I wanted to put this slide in because it's so important. If your discipline is not on point, if it's not dialed in, if you don't have the ability to stick to the risk rules, everything else is almost redundant, right? You can have the best plan in the world, but if you don't stick to it, if you can't stick to the risk rules, then it's useless. So work on you first, then implement risk rules. That being said, some of the strategies I'm going to talk about and share today will help you stick to them. They're methodical, they make sense, they're systematic to a certain degree, and some of them are a little bit different to what you used to, some of them are similar to what you used to with a different flavor. But the idea being is that you can, it's the easier they are, the more likely you are to stick to them. But I just wanted to say this because there's no point in making this massive plan and doing all this stuff and working on risk management if you can't stick to the rules. So this is me saying to you, work on you first. If your discipline needs to be dialed in, if all that stuff needs to be kind of polished off, then that's a perfect place to start. Don't ignore your risk, but make sure that you go, okay, I need to improve this sort of thing first. All right. So that being said, what are the non-negotiable risk rules? Really, there's three things. And this, I probably could have put rules in trading in general, right? Non-negotiable rules, because generally what happens is as you evolve through your trading career, you start out with a lot of rules, right? You're very, very focused on what you're trying to achieve. It's a setup. It's this, the candlestick must do this. It must do this. This is where I pull the trigger. This is my stop. This is my exit. And it's all very, very laid out for you. And it's how it should be when you're starting out. You're a developing trader. You want that growth. And you want to be able to stick to a system and a kind of methodology to improve your trading over time. Good. However, as you start to improve as a trader, as you start to kind of go through the years and the months and the thousands of hours of screen time, You then go, you know what? I actually am a little bit flexible how I will operate as a trader. However, there's three things that will always remain non-negotiable, and that is my daily risk, my weekly risk, or my max drawdown. Now, why? Because that will rule everything. You can trade pretty much what you want. You can buy exhaustion candles, you can step in front of a train, you can buy fresh highs, you can buy pullbacks, you can do anything you want. But as long as you can stick to the daily risk, then the kind of market isn't that dangerous, right? And I know there are certain markets, there are certain styles that are more risky than others. But we're talking about traditional kind of directional play on a CFD or a spread bet, long or short, on a reasonably liquid instrument. Your daily risk is kind of non-negotiable, and the same with your weekly risk. Now, you might say to yourself, right, um, I don't trade every day. Fine, in which case, weekly risk or monthly risk or quarterly risk, whatever you want. And you might also want to go a bit more advanced and say to yourself, right, my weekly risk is X. Let's say it's £5,000, for example. Just pick a number out of the air, £5,000. You say that's my weekly risk. And sort of, if I was going to slice it up into trading days, it'd be £1,000 a day. That's my daily risk. But actually, you might say, well, you know what? There are some days when I want to risk 2,000 rather than one, but it means I'm taking risk from another day. So I'm kind of pooling the risk up into one and saying, right, actually, this day's doing nothing. I'm not interested in this. This day is much more interesting. I'm going to risk double now. It's up to you how you do that, but there's non-negotiable risk rules. Your daily risk, your weekly risk, or your weekly risk, a monthly risk if you're a swing trader, and your max drawdown. And what I mean by max drawdown is there should always, I believe, there should always be a point in your equity curve where you go, enough's enough. I need to stop, pause, reflect, review. I cannot keep going like this. And that should be, somewhere off the highs. You don't want it right up near the highs, right? You want it so that you allow some drawdown, allow some time when things aren't going your way, a little bit of stagnation in your performance. That's normal. Every single trader will go through it. You will go through it. You haven't been through it yet, and you'll go through it time and time again. You hope they're not so deep. You hope to recover from them, and you will recover from them. Or you should recover from them. But there's a point where you need to go, oh, hang on a second. That's my sort of line in the sand, right? If my equity curve falls to this level, I need to step back and I need to review. I need to shut down the screens for a couple of days, however long it takes, review my trades and reflect, because you don't want to keep pummeling away at a system that's not effective, right? You're not effective. You're not effective. Your mind's elsewhere. The system's ineffective. It doesn't make any sense. So daily risk, or two types of risk: short term, medium term, if you like, and then a max drawdown. Those are non-negotiable. Anything else, I believe, is negotiable. You can play however you want the game, however you want. The rules are kind of infinite, but the risk is so important, because if you break that, you are opening the door to potential catastrophe. You might get away with it. You might get away with it, but one day you won't. And that's so important. Okay, so I wanted to say this, like, all is not what it seems with stop losses. And I'm going to say something that's perhaps a little bit controversial here, but I'll stand by it. Stops can ruin a system. And I know money's a discretionary traders here, but just think for a second like you're trading a systematized or systematic strategy, and you're kind of taking this trade and doing this and doing that. It's a simple way to manage risk. And I'm going to kind of expand on this in a moment. But stops can be the worst thing you can do to a trader. Now, why is this? Because many traders have their stops way too narrow. I've been there. I've done it. I've got the t-shirt. I thought, hey, in my early days, whatever, early 2000s, if I use a narrow stop, I've got low risk. But you end up getting a death by 1,000 cuts syndrome, right? You have your stop so narrow, you think, I've got a tight stop on this. That's really managing my risk. I'm effective. And a little bit of noise pings you out, and you're like, oh, yeah, it's a couple of hundred quid. Before you know it, you've lost 10 R, whatever your R unit may be, whatever risk unit may be. And there's no way you intended to do that. That's why going back, your daily risk is so important, because even if you get this wrong, your daily risk is fixed in the sand. It's like, hey, I've lost my $1,000, whatever I'm risking, I'm out of the game. So narrow, be very, a lot of traders fall into this trap. They say, oh, you got to use stop losses and got to manage risk and, cut the losses short and all this stuff. And it's all correct, but within context, right? And narrow stop losses are just, I think they're worse than no stop. I'm going to say it, and it might be like, oh God, how dare you say that? Honestly, I think it is. I think for most people, using a narrow stop is just these little slices, little slices, little slices. you're not going to get wiped out, but it's going to kill you. It's going to kill you because 1,000 cuts will eventually kill you. Um, a no stop is. I'm not suggesting no stop either, but people see that as, oh, it's just a nemesis, is the worst thing in the world. It's not so bad. I do think narrow stops are really, really, really bad. So, and also, why is it's bad sometimes is that constantly getting pinged out doesn't help your mindset, doesn't help that mental capital because you're like, oh, damn it, damn it, damn it, damn it. And it erodes that confidence. And before you know it, you can get into a trap where you're taking excessive risk, you're taking trades you don't want to do. And actually, here's the path of most traders: narrow stop, 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 super annoyed, then go in as maximum size on some sort of Hail Mary trade, revenge trade, buying at highs. I won't use the stop this time because I keep getting pinged out. That's the trade they're chasing at highs. That's the trade that comes all the way back, adding to it, and then that's the account obliterator. So just be mindful that we need somewhere in the middle, right? We can't have too wide a stop, no stop. We can't have too narrow a stop. There is a sweet spot somewhere. Okay, so just finally to think is, no stop isn't always the devil, right? Now, if you're a beginning, a developing trader, I think is a better sort of phrase for this. If you're a developing trader, then and also I should be aware that some people, whatever, what's the word I'm calling, experience level you're at here. It's a simple word that should have been on the tip of my tongue. If your experience is less in the markets, then absolutely use stops, right? Absolutely use stops, and you should use some kind of risk management. But thinking that no stop is like the devil doesn't help, right? Doesn't help. I believe it's necessary. Some stop is necessary, right? You need something to protect against catastrophe. Just look at the flash crash we had. Just look at all these things that come out of nowhere. You don't want to have a one in, 1,000 chance of wiping out your account. So think about this. Don't say no. I don't know stop. But remember that you can have a wide stop to protect against some sort of catastrophic event or some sort of unusual black swan event, or your system going down, or someone digging through your internet cable outside, or whatever it might be. Right? You need that. I get it, but you can also manually exit. You can be a bit more active in risk management, and that's what I kind of want to explore today. Is a more of an active role in risk management, not always falling into the default of having a tight stop, a tight stop, a tight stop, but actually starting off with a wider stop and then being a little bit more active and aggressive about how you manage the position. And I recognize that this is not for everybody. And risk management is a very personal thing, right? If you feel the need to have that stop tight, then you do that. I'm not going to tell another man or woman how to trade, but I'm just going to suggest that you think about what you're actually achieving when you're using a stop that's maybe too tight. Okay, so I believe this is a sweet spot. Again, this is my opinion on stuff. Take it or leave it sort of thing. And that's not meant to say in an obnoxious way, but it's up to you to just decide how to kind of use this information. I like to think of a stop as, hey, I've got an initial wide stop, and then I'm going to move the stop up based on price. So here's the formula. And this is something actually Linda Bradford Rashke, I'll give her credit. I'd like to give credit to anybody who kind of traded generations before me, who came up with these ideas, and they would have got it from generations before them, and the Wyckoffs of the world and the Jesse Livermores and stuff. And hopefully it kind of passes its way down and everyone spreads stuff that's valuable and useful. So Linda Rashke came up with this one, which is and others as well have said it, but she's definitely a notable mention here. Using a 3 ATR initial. I'm going to use a chart example and explain this a bit more detail in a moment. But starting off with a 3 times ATR, so your average true range set on I personally prefer to use a 10, but you can use a 14, the default setting. 3 times that, depending on what time frame you're on. So if you're on a daily time frame, 3 times your daily ATR. If you're on a weekly time frame, nobody here is on a weekly. I guess 15-minute. 3 times the ATR, 1 minute, 5 minute, you get the point. Whatever time frame you're on, it's 3 times that as an initial stop loss. You might be like, Mark, that's way too wide, but stick with me on this. Stick with me. Let's see where we go with it. Then you move your stop after price starts to go your way, because this is the problem for many traders. And hold my hands up. We've all been here. You've probably been there. I've been there. We overestimate our entry skills. We overestimate how good we are at getting a good entry. Now, there are times when you just get that chef's kiss, right? The sweet spot. You get it right on that low. You buy the low, you sell the high, and you just think you're a god, and you got a little bit of swagger about you. You just think, I can't do any wrong. Look at me. I'm the trading king. But it's rare, right? And that you don't really need to do that to make trading work, right? You don't need to be buying the low. You don't really need to be selling the high. And that means that very often we're going to get it wrong, right? We're going to get it wrong. And sometimes we need to say, hey, this is the idea and the thesis. I believe we're going to kind of hit some lows here. We're going to rotate back and we're going to kind of push back up to the opening print. We're going to push back up to prior highs or whatever it might be. But trying to time how that turn happens isn't always clear cut. Now, I probably should say this, that sometimes you do want a tight stop, just to add some more confusion into the mix. Sometimes you might want a tight stop, right? If you're playing a very specific strategy, it's a very specific momentum type strategy, then maybe. But I'm going to show you a way that you can do it that way almost anyway. So don't overestimate your entry skills, except that just assume you're going to be a poor entry, but the thesis is correct. Because how many times have you taken a trade, right? You've taken a trade, you've been stopped out, and then trade goes in your direction. And you go, man, if my stop hadn't been there, and you widen the stop there, you've just got to kind of go, right, listen, I'm not that good at getting the entry as spot on as I'd like to, but that's okay. I can still make it work. So here's something to consider. By the way, let's use an example. I forgot we had the example here. We've got a NASDAQ equivalent, Pepperstone's NASDAQ equivalent, the US 100 here, CFD, 5-minute chart. And let's say I was looking to get long, right, on here. I thought that this had gone lower. There's the opening print, the US opening bell. Price had gone lower, 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 bottomed out, came back. I thought that was a little bit of support and a higher low, and I was looking to get long. Okay, so what I might do is I'd go, right, what's my ATR on this 5-minute candle? Oh, it's running at almost 30. I need a $90 stop. You might be like, oh, man, that's wide, but we accommodate the size of the position to suit that. And things I would suggest is if you're struggling to get momentum and the results you want, then it's okay to think, okay, well, let me just rewire everything. Let me just clear the slate clean. Let me just wipe the slate clean, clear the decks, and then start from there. So start with this wider stop, the 3 times ATR stop. It seems wide, but it gives you room to breathe. It's less stressful. You don't have to be so accurate with your entry. And here's what would happen in this case, okay? You got your $90 initial stop, which is 3 times your ATR, and I've got this set on 10. And it's a 5-minute chart. It's running about 30, give or take. Multiplied it by 3 to get to a $90 stop. Fine. Okay, now what I want to do is as the trade starts to rotate in my direction, the stop is here, by the way, it's red line, I'm going to drag the stop up. So as too far, as the trade goes in my direction, as it breaks that high, and this is a hypothetical example, of course, I go, okay, I think we're going now. I think we're moving back up. And by the way, at that point in time, all you see are these 2 candles, and that looks good. It looks like it's a reversal. It looks like we could be pushing back up to highs. You might argue in the odds support here, blah, blah, blah. Fine. I'll accept any of that. But you would say, right, it's broken some type of high, some sort of structure point. I'm going to bring my stop up. So it's now gone from a $90 stop up to whatever stop that was. Almost, it's not quite break even, but almost, say, just below that low, and only because you got a good entry on that support. This one didn't work, roll back, stopped you out. So even that initial wide stop, we've ratcheted it up as price has gone in our favor. And what we've done as well is this, is that we've taken away a lot of the decision-making requirement in the heat of the moment. Because when you're in the heat of the moment and you're actively trading, and you're watching those candles tick by, up, down, left, right, whatever you're doing, hopefully not left, right, but you get the point. They're moving around, price is moving around. Your decision making should be, am I going long or not? Am I buying this or not? I know what my stop is. I've got a good idea where my price target is. I'm going to put all my resources, all my focus into making this one simple decision. Am I buying this or not? And you will find when you remove all the clutter from your mind about where to put a stop, this, that, the other, you will make much better trading decisions, much better directional trade decisions. And ultimately, direction is, most of the game, right? Long market goes up, kind of how it gets there. There's a lot of patience and all this other stuff that goes in it. But ultimately, that's kind of the meat of the bone, right? So let's look at another example, kind of a hypothetical winning example here. So 1 hour chart of cable, GBP USD. Imagine you were selling the break lower. So you sold this break lower. Pretty bad entry in hindsight, but let's say you kind of seen it move down lower, flagged at lows, it kind of wicked out above there, and you thought, yeah, beautiful. I call this a range break fake, by the way. Pulls up to the highs, rolls back over, and you sell it here. Now, you would look down here and go, actually, it's a 20 pip move on the ATR on a 15-minute chart. I'm going to use 3 times the ATR. It's a 60 pip stop. So here you go. You get short, ding, great. Now you got a 60 pip stop. And you're like, that's quite wide, but it keeps you in if your entry is poor. The nature of using the ATR function is it kind of accommodates noise. And yes, it's wide in some circumstances, but it's very rare you're going to get that full stop because you're going to be able to probably ratchet that stop up at some point. And yes, now and then you're going to take one, but it's much better taking, I believe, taking the occasional wider. And it's not particularly wide, to be fair. It's not like we're saying, oh, we're going to use a, 2000 pip stop or whatever it is. It's wide enough to be, remove the noise. That's the whole point. And I think that this is why it's a good formula. It's 3 times ATR. Is it's wide enough to be wrong, sort of in your entry, would actually be right in the overall theme and thesis of the trade idea. So this curve starts to roll, pops back up. You're like, oh, you might have been stopped initially, but with a wider stop, you're staying in. It starts to roll over. Great. When it starts to change and break structure and become into a new, I don't know if I like that phrase very much. Break structure. It starts to break a key level. Starts to go into fresh territory. Let's say that. Then you can start to actively manage your trade. And obviously, if you're trading on a 15-minute chart, you're going to start to be a little bit more looking for a little bigger moves, right? Potentially. So as it starts to break through here, starts to maybe put that high in now, roll over, you might then pull your stop up to that and say, that's a fresh place to put my stop. It makes sense. Like a stair-stepping approach. And then obviously the market rolls over. Now, appreciate I've cherry picked this example just to highlight how you could manage this type of trade. But think about how many times you've kind of taken maybe a break here, you've been stopped out, and then you've kind of not, you've not really wanted to take this here, or you've taken it here and then been stopped out here because it's gone your way and you kind of back to break even and you've not missed, and then you've missed kind of the bigger move just because it's taken longer than you expected. And I admit that's a long time to kind of sit there as it's rotating, but it's not actually breaking up to the high. And if you're trading in that higher time frame, you're probably looking for a multi-day move, right? So the idea is you start with a wider stop. As trade goes in your direction, then you start to move the stop accordingly. And obviously, as you start to roll over here, you'd probably move your stop up to that 124 point, something like that. You get the idea. You've all moved stops probably too much as the trade goes in your direction, but that's how you think about the trade. And I was talking to a trader this morning, actually. Analogy I like to use is an aircraft, right? The takeoff, you've got to get the risk. That's the highest risk, right? If you have an engine failure after takeoff, any of your pilots there, that's the worst case scenario, right? You've got no lift, you're on full chat with the engine, your engine goes completely, you've got to think fast. You've got to get yourself down into a kind of a glide position, you've got to find somewhere to land, a lot going on, versus engine failure at height, altitude. You've got plenty of time. All time in the world. Make your radio calls, look around. It's got all the time in the world because you can glide down for a long period of time. Same with the trade. The riskiest part is getting the trade off the ground, getting the trade into kind of a profitable position. You can tighten that stop up and then say, right, okay, I can relax a bit now. I'm in the cruise. The plane's cruising. I can stick on autopilot. These little nuance, little ping pong back and forth aren't going to hurt me so much. And I can focus on managing the trade and trying to get as much range out of that airplane as possible. Okay, so let's see what we've got here. Just double check we're on with good time. Okay, managing risk with size. So that was wide stop, starting to tighten things up. And I'd suggest to you, if you're struggling with multiple stop outs, if you're struggling with just not getting the results you want, so to speak, have a think about having a wider stop. It might have been something you've considered before because you're like, well, yeah, but what's the point? Like, I've got a wide stop and I'm risking such a small size. And we'll get to that in a moment, talking about size, right this second, actually, how to use size to manage risk more effectively. But think about it in terms of you're constantly getting this death stop, 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 stop. That probably accounts for maybe 3, 4, 5 little stops. Might get in a row, and you could have one wide stop and have one good trade idea. Because don't forget, the trade ideas don't come along. Good trade ideas don't come along that frequently. So I think it's better to be, risk a little bit more distance and really put an effort into getting that trade right than it is to, I'll have a go at this stopped. I'll have another go at this stopped. Because then you end up just mixing all the good trade ideas with all the rubbish ones, and you don't want that. All right, so managing risk with size. So size is an effective risk management tool. You might not think it is, but it is, right? But then if you trade too small, what's the point? What's the point? You kind of go, well, what's the point with trading so small? I'm like, oh, I'm risking, hardly anything on this. If it goes my way by 5, I'm not going to make. You can kind of go, what's the point? I'm not trading. I'm not sitting in front of the screens and learning and putting all this effort in to improve my trading game, just to kind of make a little bit more than get in the bank, right? No one's here to do that. I understand that there's risk that comes with it, but we're trying to make some money here. That's the whole objective, right? So let's talk about pyramiding. By the way, this is a huge topic, this pyramiding, and I'm just going to touch on this gently now, but it's something that you can really dig into a lot more. Okay, so managing risk with size. So we think that the wide stop ruins the system, right? You go, well, it's such a wide stop, Mark. It's like risk or ratio of the trade is really screwed up, and I'm kind of only looking for this. And if I wide stop it, kind of, we should be having 3-to-1s, 4-to-1s, 5-to-1s, and yeah, but don't forget, you're not always going to take that big stop. But let's assume we are. But if you're adding to winning trades, the game changes. And you might be saying, listen, man, this is not risk management, pal. It's supposed to be a webinar on risk management. What are you doing, man? You're going off piste here. It's not what I was promised. But let me just explain for a moment. Maybe it's not, maybe adding to trades isn't technically risk management, but think about this for a moment. When you start to get your system dialed in, when you start to get things dialed in and working, what's the next step? You want to increase your size, right? You want to make more from the strategy. The strategy is effective at 1x. You want to make 2x, 3x, 4x, 10. You want to try to move the size up. So if you do that, you're increasing the risk. You're naturally increasing the risk. If you double the size, you're doubling the risk. And you've got to be very, very careful with that. So your option is you double the size and increase your risk, or you risk half X, which is double your size, let's say, and look to add another half. So, and this is a risk management tool, by the way, because you're not risking any more initially. What you're doing is, as the trade goes in your favor, you're leveraging on the unrealized P&L and using that as risk capital, if you like, for want of a better word, on the next ad. So here's an example. Let's say you took this trade on gold, right? Short on gold, whatever reason, you thought, it's about time it rolled over. The damn thing's been rallying so hard. Breaks the support, comes back up, starts to roll over. You take a short on this kind of ignition bar here on a 5-minute candle. You've got a 3 times ATR. ATR is running about $2. Sorry about that. $2, $6 stop. Let's say your risk is $500. £500, sorry. Like, £500, right? But another way of doing it could be to say, okay, well, why don't I risk 250, same stop, same width, but then I look to add to the trade at a certain good point in the move. And if your whole, and this, by the way, it's got to be for the right trade. Some trades are A to B trades, you're not going to add to them, fine. But other trades, this is a way to reduce the risk because you're taking less risk initially on the takeoff. When it's in the cruise, you're adding more risk. Now, you don't get a free lunch here. You're giving away some of the unrealized P&L. And that's the decision you're making. At this point here, let's say you went short again, another clip. You're risking another $6. You are risking that unrealized, right? You are saying, okay, I've made, you're probably about £400 here, aren't you? It looks about 2-to-1 on that, about this point. And you're risking another 250. So you're probably going to be about break even, right? You're probably going to be about break even because you're going to risk 250 on this. You're going to lose that 200 on that, 250 on that, but you're going to make 250 there. It's going to be about break even. So yes, it's not an obvious, easy decision, but it's one way of managing risk. Rather than going straight in with your full clip, let me add to the position. A lot of people say about maximizing the trade and getting the most out of the trade. And that's fine. That's true. But I think it can be considered as a risk management tool as well, not going straight away in with that full position and adding the position as it goes. Yes, you're taking away some of the unrealized P&L potential, of course, but the thing is, if the trade thesis supports this, it's a good way of kind of managing risk. I believe it is. And something to say about this, before we move on, is it's an uncomfortable thing to do, adding, and there's probably this is a whole new topic in itself, but it's an uncomfortable thing to do. But if you can get to the point where you are comfortable doing the thing that most people aren't doing, we know the results that most people get, sadly. So if we can think the opposite way, then we can align ourselves and go, well, maybe we're going to get the results that the crowd aren't getting. And we know that, that's the results we want. We want to be in the top 10% of traders. We want to be in the top 1% of traders. Okay, so we talked about stops. We talked about size. Let's talk about time. So I believe that trade should have a time limit. Okay. And incidentally, so does this is Linda Rashke says the same type of thing. Give her credit again. Obviously, she's not the only trader who kind of supports this. A lot of traders go with the adage of, hey, trades have got to have a time expiry on them, expiry time. So, momentum trades specifically should be going quickly, and even mean reversion to a certain extent. So, how long should the trade really take before you cut it out? I think the sweet spot is kind of 6 to 8 bars, and Linda actually says 7 bars to give her credit again. 7 bars depending on the time frame you're trading. And that means that if the trade is not working within 7 bars, you cut it. So this is going back to the point of if you have that wide stop, that 3 ATR stop, the trade just sits there and does nothing for 7 bars, or you're in loss at 7 bars, you cut it anyway. So it's only if the trade goes against you right away and it just goes straight through your stop will you take a full stop loss when you're using that wider stop. It's pretty rare, right? Pretty rare. And I bet if you go back and look at your trades, you'll probably say, you know what, actually, most of the time, trades start to go my way. I get an opportunity to move the stop. Very rare that I just go straight against me, but it's there for a reason to stop. So imagine you saw this flag, you kind of drew this little downtrend, this kind of little technique I like to use when I'm getting involved in flags. You bought this flag here and then just sat there for 7 bars. Admittedly, it was the end of the day, but imagine it's not, just for this example. Sits there, 7 bars, it's against me, I'm in here, and I'm out. I'm not waiting for it to come back and hit my stop because I don't believe that I'm right. Now, obviously, in this example, it went on and on, and further it went up higher. That's life, right? Trading is going to do that from time to time. But I think having that wider stop, being able to tighten the stop up, potentially adding to the trade and managing the risk with size, and also having the time expiry on the trade means you've got quite an effective risk management system there. You've got a triangle of risk management. Like I don't let the trade go on too long without going in my direction. Tick. I have initial wider stop to kind of keep me out of the noise. Tick. Which I move up as trade goes in my direction in my favor. And then I can manage the risk with size by using a reasonable initial size on the trade. So if I'm completely wrong straight off the bat, I'm not getting completely slaughtered, but then I can sort of peel on a little bit more size and start to incrementally add to the position as the more correct I am with the trade. Obviously, it does depend on the strategy you're trading. I understand that. I get that. And if you're trading an A to B type trade, there's an obvious target. You're not going to be adding right near the target. You're just going to ruin the whole structure of the trade. But then there is an argument to say, do you want to trade in the grade A plays only? You want to be really dialed in on trading the very, very best plays that have the biggest opportunity for a bigger move? Maybe so. I think you probably do. Okay, so let's kind of run through a bit of a summary here. Actually, before the summary, there's something I should have added on the summary, is you think about your discipline and the way you manage risk at the moment. And if you're overruling your risk rules, if you're not sticking to the risk rules, if you're kind of, a little bit haphazard with that, then dial that in first. I know I said at the beginning, and I'm kind of saying it again because it's so, so important. It's almost not worth putting all this effort into, making all this structure and doing this and doing that if you don't do what you say you're going to do. So get that dialed in first. It's an easy fix. It's an easy fix. If you focus on it, you can get over that hurdle. Let's assume you've got over that. Most of the time you stick to the rules. Then we kind of go and look at this kind of what we've talked about today. So starting with that wider stop, I think 3 times ATR is a good place to start. And it's rare you'll ever take that. And if you don't believe me, just go back and look at your data. Just go back and look at your trade journals. And if you can't bother to do all of them, fine. Just pick a few and go, hey, how many times would I have taken that full stop? How many times would it have gone against me right away and I wouldn't have had opportunity to move the stop in my favor? And I'm not saying you ratchet up really, really tight as the trade goes your way. You got to give it room. But I'm saying that once it kind of breaks out of the danger zone, once you get the trade on the takeoff and into the cruise, where can you then move your stop so that your risk is much more manageable, much more palatable, and it gives you the confidence to add to the trade. So start with the wider stop, 3 times ATR, or whatever figure you come up with. It's fine. You can make your own rules, right? It's not saying you should stick with 3 times ATR here. Move the stop as the trade goes in your favor. Then consider how adding can reduce the risk. And you might be like, that doesn't make any sense, Mark. But remember, if you want to trade a specific size, you either have to allocate that risk capital straight off the bat. And the example I gave was like £500 or whatever it is, £500,000. Can't remember what I said now. You're risking that straight off the bat. You might be like, maybe I don't want to do that. I want to risk half, but I'm happy to add half as that unrealized starts to pick up. So that's something to think about. And this is where I think kind of the more experienced traders start to think a little bit, they play the game of chess rather than just developing traders go, well, I just want to get long, here's my stop, and then the game's done. The more experienced traders goes, okay, what's the initial kind of entry? That's only part of the game. Now, how do I, maximize the trade? How do I hold on to the trade? How do I mitigate the risk? How do I add to the trade? Am I peeling some off? Am I adding some here? And thinking about the trade in the whole duration of the trade rather than just setting it and forgetting it. I'm not saying there's not a place for that, but I think that there is that extra little layer of edge there. And think about the 7-bar time-based stop. So again, 7 bars, an arbitrary figure. Again, Linda Rashke does recommend that. I think it's good as well, but you can choose. I think it's just choosing one, a time expiry for your trade and saying to yourself, listen, if the trade doesn't go my way after this period of time, I'm done. And with that combination, you now kind of rejig the way you think about risk, right? You say, I'm having a wider stop. I'm not going to be death by 1,000 cuts. So I'm going to remove the chance of that. I'm going to kind of be a bit more proactive with my risk management as the trade goes in my favor. I'm going to do the uncomfortable thing that most people struggle with by adding to the trade, but I want to kind of get to the point where I can add to the trade to reduce the initial risk. And that's if you're trying to trade more size, right? And then I'm going to say, hey, if the trade doesn't go in my favor, straight away I'm out. And now you've got something that's a really good, process to manage risk. And again, this is ideas and thoughts and ways to think about this. But I urge you to go, right, let me get my trading journal. Let me get a pen and let me write down and say, this is my risk management plan, my whole risk management plan. I'm making some effort into thinking about it more focused and in a more, in a deeper way than other traders do. Other traders go, I'm going to have a stop. I'm going to put a stop under the list low. I'm going to put a stop below the candle. And that's okay, but it's not good enough. It's not good enough to get the results. I don't think. I don't think. I think you've got to put more effort in and go, hey, I need to do this. I need to do this. I need to think about my time. I need to think about the wider stop. I need to think about moving the stop up. How I'm adding to the trade to reduce the risk. All that needs to be thought. Document it out and go, right, now I feel good about it. I've got my daily risk, my weekly risk, my maximum drawdown risk. Treating it more seriously. And just by going through that process will give you you sort of sit a little bit prouder. Your shoulders go back. You're like, yeah, I'm taking this seriously, man. I've got my risk management plan here. I've got my kind of trading plan here for how I'm going to enter the trades. I'm planned out. I'm not saying that you completely remove all discretionary ability from a trade. I think that's the wrong thing to do, especially with a discretionary trade. Don't shackle yourself with rules. But when it comes to risk, going back to that initial quote, that's the one thing you can control. You can't control where the market's going to go. You can't control what the market's going to do, but you can control your risk. You can control how you will behave when the market goes up, how you'll behave when the market goes down, i.e., for you or against you. You can control that. And so the more you can plan that and structure that in a methodical way, then the better results you'll get, because then your brain power just goes to, hey, this is how I'm looking for direction, looking for a good place to get long, looking for a good place. Now, no, wait, a little bit more of a pullback. Is that an exhaustion bar? I think it is. Okay, my long, my wide stop. And if my timing is not quite right, that's okay, because I've got a wider stop. Oh, I missed it by, that's okay. No, now it's turning. Oh, now I've got a bit of rally, comes back support. When it breaks a high, I'm going to move that stop. Breaks the high. Okay, move my stop. Where's the add on this? Don't want to buy that. You start to think a little more strategically, and you start to think of a few moves ahead rather than just being reactive. And a lot of developing traders like, oh, so it's moving. Oh. You're getting seduced by in the market. You determine when you risk capital. You determine when you move your stop. You decide that. Okay, I'll take some questions if you've got any, ladies and gents. A reminder, if you haven't yet, you can sign up for my free daily emails, send out every morning. There's about almost 10,000 traders on there now, growing massively because you guys are sharing it and you like what I talk about. I talk about everything from risk management, trading strategy, the lot. So let's have a look at the questions. I will take a breath after getting on my soapbox about risk management. And look at your questions. Okay. Couple of questions in here from, let's put it here so I can keep the camera in front of me. Rob said, this is super valuable for everyone. And it took me far too long to realize that tight stops were killing my account. I now look at stops as invalidation zones placed where the trade idea is no longer valid rather than how much size I want to employ. I exit trades manually more often than not now, even those in drawdown. Interesting, Rob. When price seems to suggest that the trade is unlikely to work out. Yes, and that's another very, very good point, one I didn't cover, is you can manually come out of a trade before it hits your stop. Now, if you're constantly doing that, then you're probably getting scared and you don't want to do that. But if the trade isn't working, isn't doing as you wanted it to do, just like the time stop, you might go, you know what, it's been sitting there. I don't like the look of this. I'm going to cut it. And, just like you said, Rob, there, I honestly, I think that's most traders that don't realize that tight stops are you're just taking a little paper cut, a little paper cut, a little paper cut, and it adds up. And before you know it, you've taken a huge drawdown. You're like, how the hell have I taken that much drawdown? And actually, it's because it's just these little nicks, and you almost don't care, maybe a bit blasé, but you almost don't care because you have the tight stop and the risk is so small financially. Seemingly, you're like, oh, it's another $100, another $100, or whatever, $50, $20, 1,000, whatever the number is to you is irrelevant. But you almost don't care, and then it adds up and it adds up and it adds up. And actually, it's better to say, right, I'm going to take a bit more risk, a bit of a wider risk, and I'm going to take fewer trades, and I'm going to let the trades work and let the trades mature. And that's a much better approach, I believe. But yeah, good one, Rob. And actually, yeah, the good comment there of I want to look into place my stop in places where the trade is no longer valid, rather than kind of keep it tight and just say I know I'll risk this amount and placing it based on that. Okay, yeah, thank you, Rob. Okay, Barry Ward, thanks, Mark. Good stuff. If a trade goes against me and it's still within the 7 bars, how can I decide to get out early, or do I just give the trade room to breathe and potentially hit stop loss? That's a good question, Barry. I would initially say to you, don't meddle with it, right? If it's not hit your stop, I know Rob was saying he kind of actively manages the trade if it goes against him, but I think you do that. You can do that at the next level. But I think for now, you just say to yourself, okay, I'm either going to come out on my stop or 7 bars, or I'm going to move my stop up as the trade goes in my direction. Those are the only 3 outcomes I can have. I'm not going to try and be clever. I'm not going to try and do anything that I kind of confuse things. Those are the only 3 things I'm going to do. Now, later on, when you go back and review, you might say to yourself, well, actually, you know what? When this trade's not going my way, when it's going against me, it's not quite hitting my 7 bars. This type of pattern often indicates I'm going to take a full stop. So I don't need to kind of wait for the full stop. So something you can do, but I reckon don't do it for now, but maybe go back and look at data on your trades and go, actually, I could maybe make more actively manage stuff. But just be careful you're not doing it because you're scared of taking the full stop. The point of the stop is that it's there to mitigate the noise. It's there to kind of stop you getting pinged out on noise. Victor says, thank you so much, Mark. Appreciated. Anonymous attendee says, please share your email address. If you want to contact me, support@tradersmastermind.com. That will get to me. And if it's a question, happy to help. If it's not, then I don't think I'm going to help you. Okay, Rajinder Singh says, thanks for the presentation. Useful information like the 7 bars based stop will incorporate that into my strategy. Good. And Rajinder, let me know how it goes. Actually, you can reply, by the way, if you sign up for my daily email, you can reply to that. And if it's a useful question or something you want an answer to, it will get forwarded to me and I will do my very, very best to help you out. All right. We shall call it an evening there. Ladies and gents, thank you so much for your attention. I hope that's been of value to you. See you on the next one. Keep your risk managed. Take care. Bye-bye.